Hey guys, here's a fun fact about pivot points. The market trades to the central pivot point around 60% of time. This means that every day there's a chance of 60% that the market will reach the main pivot point. To me, that's a pretty good probability compared to the 50% odds of the market going up or down. But what if we add the opening gaps into setup? Well, believe it or not, the chances of hitting the pivot point are even higher. So in this video, I will show you how I trade stocks during the opening session, taking into account just gaps, pivot points, and simple price action. Before we continue, if you are new to the channel and you find value or you learn something new, please consider subscribing and leave us a like to show your support. So, one of my favorite trading setups occurs when I see a market gap at the open of the session. When this happens, I use the pivot points to either trade a potential breakout move or fade the market for a fill of the gap. Here is the logic behind the strategy. A gap at the open indicates that the market sentiment has changed overnight, and logically, the market is bound to move in the current session. What I've observed during my years of trading is that the central pivot point can have a magnetic effect on price, which in our strategy can lead to a high percentage fill of the gap we're trading. The central pivot point is the main focus of the market. This pivot is basically a powerful price-based support and resistance level. We just have to add the previous day high, low and close and divide this amount by 3 and we'll have our central pivot point. For this technique, we don't even need all pivot levels on our chart. I just keep the central one and the S1 and R1 levels. If you remove all the pivots below S1 support, you are forced to remain disciplined to a bullish trend by looking for long opportunities at S1 and at the central pivot point. Likewise, removing all pivots above R1 forces you to search in the direction of a bearish trend. This seems like a simple concept, but many traders can lose focus of the trend through all the noise that comes along with trading, especially if you are day trading. I previously said that we need a gap to increase our chances. A price gap occurs when something important influences the market at a time when the exchange is closed. Gaps can also occur because of a large cluster of orders placed at a point where the stock breaches through support or resistance. I don't want to insist too much on gaps. We'll have plenty of examples later. All you need to know about them is that there are 4 types of gaps. We have the common gaps. The common gap appears as a space on a chart and is brought by normal forces. There is no major event that precedes this type of gap, and it generally gets filled quickly when compared to other types of gaps. We have breakaway gaps. A breakaway gap occurs at a point of clear resistance or support, when there are a large number of buy orders above a major resistance line or sell orders below a support line. Also, we have exhaustion gaps. An exhaustion gap occurs at the end of a sustained and volatile price move and confirms the reversal. An exhaustion gap signifies a clustering of orders anxious to exit the market. And finally, we have runaway gaps. A runaway gap occurs at different points during a clear trend. It is characterized by a significant change in price in the direction of a trend. Now that we have briefly explained the gaps and the pivot points, let's dive right into the strategy. So we know that the price is likely to reach the main pivot point, and we also have a gap that has a high probability to be filled. How do we trade? We buy or short the market with the aim of reaching the main pivot point. Let's take an example. This 15-minute chart of Apple stock illustrates a perfect trade. The stock opened the day with a gap up and formed a bearish reversal pattern. Since the central pivot point was around the previous day's close, there was a high probability that the price would return to that area, which was indeed the case. The bearish reversal setup easily triggered an entry on this day, as price dropped steadily to the central pivot point before finding support. And here we have another example. The session opened with a gap down and formed this time a bullish reversal pattern. The central pivot point was around the previous day's close, so we have a high probability that the price would return to that area. Remember this rule because it's very important for our setup. The central pivot placement should be at or very near the previous day closing price. When this is the case, the central pivot point helps attract price to fill the gap. The bullish reversal setup triggered a buy entry on this day as the price reached the central pivot point before finding resistance. Here we have the Tesla stock with the same pattern. The session opened with an upward gap, and after two bearish reversal candlesticks, the price headed back to the central pivot point. You must remember that the goal of this strategy is to play for a fade of the gap back toward the central pivot point, meaning that the trade will be short with little room to breathe. Aim for the main pivot and exit the trade as soon as the market hits this area. If you can get a little more out of the trade, then go for it, but don't wait all day for the gap to fill, because the longer the trade takes, the more unlikely it is to fill. Another important factor to consider when trading this setup is looking for additional pivot confirmation at S1 and R1 levels. If the price gaps up to R1 resistance or down to S1 support, these pivots can serve as a barrier which leads to a higher percentage of filled gaps. On this Tesla chart, we see the R1 level offering resistance, and after that level was rejected, the sellers took control of the market and drove the price back to the main pivot level. This was a riskier trade because the main pivot wasn't as close to the previous day closing price as I wanted. Also, be careful when the market gap is large. Gaps that are too large don't tend to fill as easily as those that are moderate in size. When this happens, you'll often see that the price won't go back to the main pivot point and will find resistance at R1 or S1 levels. In this example, on the same Tesla stock, we have a $10 gap and the price found support at R1 level. Basically, it is the same pattern as we talked before, but because the gap was too large, the market found support at the nearest level, the R1. And here we have a big down gap on the Facebook stock. The price found resistance at S1 pivot point and continued its downward direction for the rest of the day. So, when we have big gaps, the likelihood for getting filled is low. The trend can also play an important factor in the successful outcome of this trade. When a market has formed an established trend, the price will usually pull back to the main pivot point before resuming in the direction of the trend. Therefore, if the market has formed an uptrend and the price gaps in the direction of the trend, there is a good chance that the price will drop to the pivot point before another round of buying pressure is seen, thereby causing a fill of the gap. So, in this Visa chart, we have a clear uptrend with higher highs and higher lows, and we saw this gap and the rejection candle at the R1 level. The perfect trade would have been a short position aiming for the main pivot point, and then a buy position at the central pivot point in the direction of the main trend. You could skip all the way the gap from the equation and start searching for long positions only. So a conservative approach here would be to acknowledge the gap, to acknowledge the fact that the price is likely to reverse to the central pivot point and enter long on the market when the price finds support at the main pivot point. If you learned something new or found value, please consider subscribing to our channel, share and like this video, as it will help us a lot in the future. Until next time.